Let's continue with another method of valuing companies, and that is using relative valuations. Relative means comparing something to something else. In finance, we use the words relative or its opposite, the word absolute. And then you can probably remember it if you've studied about funds. You know that ETFs are compared to an index, to a benchmark, so we call it relative valuation. Hedge funds, on the other hand, they don't have a relative valuation. Hedge funds are compared to their own performance, so we call it absolute valuation. So absolute is when you compare something to itself. Relative is when you compare something to something else. So in this relative valuation, we are trying to find a valuation of a company, and we are going to be using something else. It's the market, basically. We are going to compare the valuation of a company compared to its sector, compared to its market. Before we look at the different ways to do that, we just have to consider what goes into comparable valuations. The size and future growth prospects of the company. I don't think this is something you will be questioned on. You have to also consider the risk of the business, since these valuations do not include that. The scope of product offerings, because sometimes this company that we're obtaining we are obtaining a valuation for, it would have a wider scope of offerings than the other companies in the market. They might have maybe different customers. They might be catering for different countries and regions, and they might have different profitabilities. So assuming that you have a certain company, let's call it company F, and I want to obtain a value for company F. One of the ways for me to do it is to look at the current market valuations and then work backwards. So the first thing is we need to look at the ratios for the sector. We look at the PE ratio. This is historical. And then we look at the PE ratio, prospective in the future. EV over EBIT, the PB ratio, and EV over EBITDA. So let's look at the peers. That means other companies similar to company F. Let's look at its peers in the market. Companies A, B, C, D, and E. This is their market capitalization. This is the historical PE ratio for these companies, A, B, C, D, and E. So once we add all of these and we divide them by 5 companies, we get an average for the sector or the market, an average of 16.4 PE ratio. This is for the historical, for the prospective. These are for the companies, and this is the average for the sector. This is the EBIT, the EV over EBIT, the enterprise value over the EBIT. For the sector, this is the PB for the sector, and this is the EV over EBITDA for the sector. Usually, in the exam, CISI would give you these, and then CISI would say, find me a valuation for company F. Of course, CISI will give you more information, but you will get a table similar to this table. Maybe not all of these ratios, but these are the ratios covered in the book. So maybe you'll get 2 or 3 of them. Because of time, you only have like 1 minute per question. So you would already be given this, or maybe you'll be required to calculate it. So CISI will just be giving you these companies, and then they will tell you, give me valuation for F. So the first thing you need to do is first of all, find the average for the sector. So divide the numbers, add the numbers and divide them by N. So once you have the average for the sector, we can now get a valuation for company F. Let's look at a quick example of this. So this is the table from the previous page. We looked at the valuations of the companies, the ratios, and we obtained an average for the sector. I think this is a simple average. I haven't, to be honest, looked. Did I take a weighted average? Well, it is. For us, we will, yes. For us, if you are going to be looking at, you have to use the weighted average, because some companies are very small. Look at this one, and then some companies are quite larger. But in the exam, not the weighted one, probably just the average one. In the exam, you are more likely to be given this, and just say calculate the comparables. So here's a quick question. Assume that a comparable company, in this case, let's call it company F, to the group on the slide, has the following earnings. So we know that company F has the following earnings: 35 million. These are historical. Prospective earnings, this. Shareholders' equity, 320 million, which is the book value. EBIT, EBITDA, and net debt. So the equity of this company, company F, will more likely be between what? Which of these? So let's do it one by one. Remember, if you have the PE ratio of the sector, which in this case is 16.4, and you want the price of the company, you already have the earnings, which is 35 million. To obtain the price or the value of the price of the value of the company, just multiply 16.4 by 35. And you do it for all of them. So 35 million into 16.4, these are for the historical PE ratio. This is going to give us a valuation of 35 million by 16.4, so 574 million. If we use the PE ratio, the historical PE ratio, if the sector is 16.4 average PE ratio, and this company has earnings of 35, we can obtain an estimated valuation of 574 on the historical PE ratio. On the prospective, the market average or the sector average is 14.6. We multiply it. 39.5 times 14.6. That's going to give us a valuation of 576 million.7 if we use the prospective earnings. The shareholders' equity of this company is 320 million, which is the book value. So the book value average is 3.8. So using the book value or the price to book value, we would get an estimated value of this company of 576. We have the EBIT and we have the EV over EBIT. So we can arrive at the EV by multiplying the EBIT by the EV over EBIT times 8.4. So 75 times 8.4. That's going to give you 630 million. But watch out here. Remember, we are obtaining the EBIT, the EV, not the equity value. So what we need to do is you need to deduct the value of net debt, right? And you've been given the net debt of 50 million. So minus 50 million. So for equity, 630 minus 50, you'll obtain a value of 580 million. Please don't forget it. Lots of our students forget that. Regarding EBITDA, EV over EBITDA, 6.3. So 99 times 6.3. 623 million. Again, this is for the whole enterprise. To get the equity side, we need to remove debt, minus the 50 million net debt. So that will give you 573.7 value of the company using the EV over EBITDA method. So we will note that this company is, I would say 573 is the lowest valuation and the highest one is 580. So which one is the closest? 550? No, this is very far. To 560, no. 560 to 570, no. 570 to 580, yeah. Because according to this, it's between 573 to 580. So this is the closest answer. So we have now valued company F using comparable. Let's get into the final part of this chapter and the final way of doing evaluation. That is the cash flow based valuations. Valuing a company based on its cash flows. Quite popular. This is basically DCF. So discounted cash flows. I mean, obtaining the MPV of a certain company. So the process of the valuation is estimate future cash flows for a certain period of time, like 5 years or 10 years or 15 years. Estimate the value of the cash flows after the finite period ends. So this is what we call the terminal value. So at the end of the 5 years, what do you think the value of the company would be? Determine an appropriate discount rate. That's a big assumption right there. So expected return, whatever that is. Calculate the present value based on all of these cash flows. The limitations of this, just we covered these in chapter 1, limitations of the MPV. Many assumptions are used for the cash flows. Also, getting a terminal means final end value. We'll cover this in a bit, don't worry. Is based on some subjective growth, because we are going to have some growth assumptions there using the Gordon growth model. How are you sure that the company is going to grow by 5% every year? Where did you get that number? What if some years it doesn't grow by 5%? Again, the discount rate you are going to be using is based on some certain assumptions on the capital structure, which is the WACC. So using the discount rate, you are going to look at the cost of equity and the cost of debt. And if it has some preference shares, the cost of the preference shares. So these by themselves are quite some big assumptions. So everything you're going to be using when it comes to valuing companies based on assumptions. So what do? Not do it? You have to do it. So again, we are going to repeat what we covered at the beginning of this chapter. You have to estimate the free cash flows. Free cash flows available to the firm, which is available to everyone, both the debt and the equity holder, and you need to discount it using the weighted average cost of capital. I'm going to remind you of the free cash flow quickly. So it's the EBIT. So we wrote this for you. It's the EBIT, take into consideration the effect of tax. By the way, this is called NOPAT. And this NOPAT comes a lot in the exam, by the way. It's the net operating profit after tax. So if you are given the NOPAT, no need to take into consideration, no need to adjust it for tax anymore, because it's already adjusted for tax. Watch out for these traps. There's a lot of them in the exam, especially when it comes to tax. If CISI gives you any number which is post-tax, no need to adjust it for tax anymore. And then you've got the non-cash costs like depreciation and amortization, and then you have to adjust it for working capital, and then you have to deduct capex, right? So you get the free cash flow for the company, for the firm. So here's a quick example. I'm going to give you 2 minutes to calculate this quickly by yourselves. Let me just read the question for you. A company has operating profit of 1.7 million, depreciation of 0.3 million, and a tax rate of 30%. It has seen its accounts payable decrease by 0.2 and its inventory increase by 0.4. Its capex, capital expenditure, 0.5. Calculate the enterprise cash flow to the firm. You've got 2 minutes. This is a very, very popular question. It's a copy-paste from the exam. The only thing that changes are these numbers. So you've got 2 minutes and we'll solve it together. Okay, so let's solve it together. The enterprise cash flow, or the free cash flow, free cash flow for the firm, to the firm, is your operating profit adjusted for tax, plus the non-cash costs or expenses, plus or minus changes in working capital, minus capex. Sorry. So our operating profit is 1.7 million. So this is not adjusted for tax because it's not NOPAT. If CISI said that this was your NOPAT, the net operating profit after tax, then you don't need to consider tax anymore. But it didn't say that. So this is not NOPAT. This is just ordinary operating profit. So we have to consider the tax effect. So 1.7 million adjusted 1 minus tax. Add to that depreciation and amortization, 0.3 million, sorry. Is there any amortization? No. So we have to deduct or add working capital changes. So what are the working capital changes? Changes to usually your payables and your receivables and your inventory. It says here that payables decreased by 0.2. Payables is the amount you have to pay to your creditors and suppliers. If that amount decreases, that means you have paid. You have used your cash to pay, so your payables balance have went down. So if the payables have decreased by 0.2 million, it means you have used cash minus 0.2 million. My cash balance have gone down by 0.2 million. And the inventory has increased by 0.4. How does the inventory increase? By you spending money. When you buy inventory, the balance increases. So if the inventory increases, you've used cash. So your cash has gone down by 0.4 million. Its capex is 0.5. That means your capital expenditure is 0.5 million. You have used cash to spend on capital expenditure. So 1.7 adjusted for tax. So 1.7 times 0.7, 1.19 million plus 0.3 million minus 0.2 million minus 0.4 million minus 0.5 million. Add this all together, 1.19 plus 0.3 minus 0.2 minus 0.4 minus 0.5. This should give us 0.39 million. And the answer is B. Yes, you're right, Pankaj. Excellent. So that is the enterprise cash flow. Let's look at the equity cash flow, which is the cash flow, free cash flow available to the equity holders. In the very, very same way, we've looked at this, but instead of EBIT adjusted for tax, we have to remove the interest first from it. Quick example here. A company has an operating profit of 1.7, depreciation of 0.3, interest expense of 0.4, tax rate of 30%. It has seen its accounts payable decrease by this, inventory increase by this, capex is 0.5. Calculate the equity cash flow. Let's just do it quickly together. So it's the EBIT minus tax, so 1.7. EBIT minus interest, sorry, forgive me. The interest is 0.4. Adjusted for tax, 1 minus 0.3. Out deduct depreciation minus same thing like the previous example. Decrease in payable means we've used cash. Increase in inventory means we've used cash. Capital expenditure, we've used cash. $1.7 times 0.4 minus 0.4. It's 1.3. Adjusted for cash, for tax, plus all of this, minus all of this. Let me just do this quickly. Times 0.7, plus 0.3, minus 0.2, minus 0.4, minus 0.5. So give you 0.11. This. You'll get the access tomorrow, inshallah. Tomorrow afternoon. So now that we have the cash flow, and whenever we are valuing a company, we have to discount that cash flow. Remember, the discount factor is usually, if it's debt only, we use the yield to maturity. If it's equity only, we use the required rate of return. If it's both, we need to take the average or the weighted average cost of capital. Assuming that this company has a weighted average cost of capital, 10%, this means that the cash flow coming in should be adjusted by 10% every year. So which is basically in the year one, you divide this by 1 plus 10% for the first year. For the second year, you divide it by 1 plus 10%. For the second year, for the third year, for 3 to the power 3, and then for the fourth year, 1 plus 10% to the power 4, and for the fifth year, 1 plus 10% to the power 5. So let's just do this quickly. 122 divided by 1.1. So in the first year, the value of the cash flow is this, or 9.1, I think. In the second year, 132 divided by 1.1 to the power 2. So the value is 109.1 or 09. In the third year, 145 divided by 1.1 to the power 3. 108.94. In the fourth year, 167 divided by 1.1 to the power 4. 114.06. And in the last year, 198 divided by 1.1 to the power 5. 122.94. So we add them all together to get the present value of the cash flows, 110.91 plus 109.09 plus 108.494 plus 114.06 plus 122.94. This will give us a present value of these cash flows, 565.94 in millions. So let's do a quick question here. So assuming the same example from the previous one, from the previous page, given that the enterprise cash flows and the discount factors presented on this slide, if we assume a 2% constant growth rate in cash after year 5, what is the current value of the firm? So we remember the current value of the firm is the current value of the cash flows for a certain finite period of time, let's say in year 5, plus a terminal value for the firm, and you add them all together. So what is the terminal value? I think we already have the value of the firm here. I think we calculated as, let me just, I think we have it here, 110.9. You can see from the previous page, 109.09, 108.9, 108.9, 114.1, and 122.9. So those are the discount rates. So at that time, this gave us a valuation of 565, if I'm not mistaken. Good. But this is only for the first 5 years. And if we are really going to be valuing this company for the rest of its life with the terminal value, we have to include that in the calculations. So what is the terminal value? The terminal value is basically the value of the cash flow on the last year adjusted for growth. What is the growth here? Constant growth of 2% divided by 2%. Do we have a rate? Okay. 1 plus growth, 2%, over the discount factor, which is the WACC, which on the previous page was 10%, and was the growth, which is 2%. So what happened here? What happened is the last payment adjusted for growth over R plus R minus growth, which is the Gordon model. This is what we put here. This gives you the terminal value of the company on the final year, year 5. Let me just do the calculations quickly. 198 times 1.02. So that's going to give you 201.96 over 8%. This is going to give me a terminal value after year 5 of 2524.5. So this is the terminal value of the company. So just like we took the present value of the cash flows, we have to discount this terminal value by the weighted average cost of capital, which is 10% in 5 years, right? This is in the 5th year. So 1.1 plus 10% to the power 5. So the terminal value, the present value of the terminal value is 2524.5 divided by 1.1 to the power 5. This gives us 1568.13. We add that to the present value, 565.9. This would give us 2134.03. So this is the value of the enterprise. The present value of the cash flow for the first 5 years, the present value of the terminal value after you consider the effect of the cost, is going to give you 2134.03. That's the closest answer. Right. Just like we said on the previous page, if CISI doesn't give you any growth, and that's rare because from the feedback of the students, there is always growth at the terminal value. If there is no growth, you just look at the cash value on the last year over the cost of equity, the cost of capital. If there is growth, you have to adjust it. 1 plus growth, R minus growth. Cash flow based valuations, just like we said at the beginning, in order for you to arrive at the enterprise value for a company, you look at the value of the equity and the value of the debt. Remember, you need to make some certain adjustments. For the equity, if there is a minority interest, you have to take it into considerations. If there are some preference shares, you have to take them into considerations. For the debt, you take the debt value, total debt value, but you have to remove the cash. So we've covered this before. The enterprise value equals to the market value of the equity plus the market value of the debt, net debt. So for the equity, don't forget the minority interest and don't forget the preference shares. For the debt, always look at the net debt, which is the total debt minus cash. So is the market capitalization, which is the value of the shares in the market, which is the price of the shares times the number of shares. This is assuming that this company only has ordinary shares, then that's fine. That's the market value of the equity. But if that company has minority interest and so preference shares, please don't forget them. And you have to add to it the value of debt. So you look at the value of debt, but don't forget to remove cash. This will give you the net debt. And this will arrive at the enterprise value of the company.